When interest rates change, the market value of your existing bonds can swing. Here is how interest rate risk actually works for investors. At its core, this risk is about price volatility. When rates go up, the value of older bonds with lower interest payments drops. Think of it as a seesaw. When market rates rise, the price of your fixed-rate bonds must fall to remain competitive with new issues. Several factors amplify this risk. The longer you have to wait to get your principal back, the more sensitive your bond is to rate changes. Short-term bonds are generally more stable, while long-term bonds react much more aggressively when the Federal Reserve shifts interest rates. This chart shows how a 1% increase in rates impacts bonds of different maturities. The longer the term, the deeper the price drop. Remember that price risk only becomes a realized loss if you need to sell the bond before it reaches its maturity date. Interest rate risk is a natural part of bond investing. Stay informed and consider your time horizon. Thanks for watching.